So what we've got here is global markets in 2021. So this slide goes up to the 11th of June 2021, and you've got different markets from around the world. So you've got the FTSE 100 and the FTSE 250. People will be familiar with, I'm sure, and they essentially represent UK stocks. You've got the MSCI Europe X UK, which is a representation of Europe, S&P 500 the US, and finally MSCI Emerging Markets, anywhere from different emerging markets essentially throughout Asia. And you can also include in that some emerging markets within Europe, but it tends to be dominated by places like China, for example. So what we've seen this year is UK stocks have done significantly well. And the reason for that is because ever since we got news of the vaccine efficacy results in November 2020, what we've seen is a big recovery in UK stocks. So UK stocks previously are very full of, well, UK industry is very full of companies such as mining companies, such as utilities, such as industrials, such as oil companies. Companies which essentially thrive off activity in the economy. Now, naturally, through 2020, nobody's flying anywhere. People aren't necessarily building things, etc. And as a result, what you actually saw in 2020 was the UK economy really struggled. So as soon as we got those vaccine efficacy results, suddenly the market took a very different view on the UK, thinking, right, okay, well, realistically, things like oil prices are going to go up, so those oil stocks go up. Things like airlines are potentially going to do better as we start to reopen. All this activity of reopening has really benefited the UK market because essentially they're the sorts of industries which benefit from that activity. If you compare that to somewhere like the US, which is very overweight things like technology stocks, for example, and things like healthcare, they're the sort of things that did well in 2020 during the pandemic for obvious reasons. You know, there's a lot of stay-at-home stocks in things like the S&P 500. In fact, a quarter of the S&P 500 is dominated by things like Facebook, Amazon, Alphabet, etc., things like that, Netflix, those sorts of stay-at-home stocks, which is why that did very well last year. So this is why we've really seen that big UK drive. Now, at the other end of the scale, you've got the MSCI Emerging Markets, and that has really struggled essentially because, first of all, you saw a big bounce in the sort of emerging market space at the end of last year, but also because there's been a lot of policy tightening in places like, well, in certain markets. So, for example, China. So in places like the US and the UK, we've seen continuous stimulus over time. In places like China, that stimulus has been brought back a bit, and investors almost lost a little bit of confidence there. If you couple that with things such as the coronavirus and how it's spread in places like India, in places like Brazil, and different case levels around emerging markets, parts of Asia, etc., that's coupled into the premise that emerging markets has lagged behind more developed markets so far into 2021. Now, one of the big themes that I also want to talk about, which stems from this, is this idea about different investment styles doing well. So what you tend to find in the world of equities, or the world of stocks and shares, so to speak, is different fund managers will take different styles. And these are the three main styles that fund managers take. So you've got value, quality, and growth. Now, the next slide will show us this, but essentially for the past 10 years, quality and growth have done very well. And examples of growth stocks would be things like your Netflix, your Facebook, your Amazon, your technology stocks, okay? And then things like your value stocks would be maybe things like automakers potentially. So maybe things like a Volkswagen is a very good example of that. So value is stuff that is seen as unloved, okay? And maybe what some might see as potentially industries of the past. And what fund managers are trying to do in the value space is find organizations that the market sees as undervalued for now, but really there's changes that can happen that are going to bring that company back to its fair value. And essentially that's how they make their money. And at the other end of the scale, you've got the growth managers who are really just not as concerned about price. So they're not concerned about the value that they're necessarily getting. They're just looking to see that a business has got consistent cash flows, consistent growth, and that is continuing to happen. And the chances are that it's going to continue to happen for a fair period of time. So growth you might see in some instances also with a bit of a slash next to it, referred to as momentum as well, because it's really what's going on in the market at the moment, what's growing, that sort of momentum piece. And then quality sits in the middle, because quality is businesses that have competitive advantages. They tend to be companies which are more about needs as opposed to wants, and they've got things like very strong profitability for their investors, and they're never going to necessarily have years where they shoot the lights out, but they're also going to have they're never going to have years where they don't they do poorly. They consistently tick over time, hence the name quality. So they're the three different styles in the market, and the next slide shows us that over time, as I alluded to before, these different styles come in and out of favor over time. So the slide with the 10 years shows you how value has really lagged behind quality and growth as an investment style over the past 10 years, with that really coming into force really from that April 2015 point in the 10-year chart. Then at the same time, when we saw these vaccine results come in, the market really started to take a look at growth, and it really started to take a look at the quality side of things, and it started to say, right, okay, is there potentially some overpricing in some of these industries like technology, etc., and am I going to get a better return by investing in some of these undervalued, very undervalued stocks in the value space, such as those oil companies, etc., which I mentioned in the UK. So the UK is full of more value stocks, okay, and places like the US are maybe full of or overweight your more growth stocks. The UK is not really full of those growth stocks. So value in the UK doing well is not a coincidence. It's because a lot of those value companies are in the UK, because they're the sorts of industries. So as you can see, value has done really well for the past 6 months or so. I mean, this chart's up to the end of March, and it continues to do well. So what does that actually mean? Why is that important? Okay, now it's really important because in your investment portfolio, it's really important that you have a balance between the three different investment styles. So what we do at SJP when we create our portfolios and when we create our individual funds is that we ensure we've got a style balance. So over the last 6 months, if you're just invested in quality and growth, your equity side of your portfolio is going to potentially have lagged quite a lot because you've not had that exposure to value stocks. If I look in our fund range, our specific funds which have got value managers in them are the ones that have performed the best. So it's about having that style blend. And when we create our funds and when we create our portfolios, we ensure quite clearly that there is a good balance between these three individual styles that we've got in there. Now, what we also do in our portfolios while we're on the area is we ensure we've got a good spread of managers. So we have made changes at the back end of last year to our portfolios to essentially ensure that we have got not only an even better style balance than we already had, but also so we've got reduced manager concentration. So in our fund range, for example, we've got 3 funds. We've got a fund called Global Quality, one called Global Value, and one called Global Growth. And what we ensure within those funds is you've got, so for example, 3 managers are in the Global Value Fund, 7 in the Global Quality, and 4 in the Global Growth. And the reason for that is because different managers, as another level down, approach value in different ways, approach quality and approach growth in different ways. So it's really important that we have a mix of those different managers. And what it means essentially is that if one of those managers has a tough time of it, the whole fund doesn't necessarily suffer.